Hi there, and welcome to the end of this trading week and to your weekly wrap-up. I'm joined by research analyst with Alpari UK, Joshua Mahony, and we'll be going over the key events which have shaped the markets this week. Welcome back, Joshua. Now, I want to begin by looking at oil. The commodity was causing some serious impact over the week, still falling on this last trading day. How are the markets reacting?
I think really the way to look at this is, who this is good for and who this is bad for. I think the initial reaction within the markets when we saw the oil price tanking and when we realised that OPEC weren't really going to do anything about it, was that we saw selling coming into the major indices. And that really was in line with the fact that it was hitting some of those major energy companies and they were dragging down the indices. So the first reaction is who's going to get hit the hardest and who's going to get hit most near term, essentially. And then once that kind of goes away, we've seen some strength coming back into some of the indices, and people are starting to realise that in actual fact this is a very good thing in terms of the consumer, in terms of the money that people are going to have spare to be able to invest in other things within the economy. It's also going to be beneficial for a lot of the companies around the world that use transport and the like, and it's going to be bringing down their costs and increasing their profits and revenues. So I think overall, at first people were very worried about what it was going to mean for some of these energy companies that people are investing in, and have kind of trimmed back some of those positions on that. But now we're actually moving towards a position where everyone's actually a little bit more positive about it and not necessarily worrying about it as much.
Looking to the Eurozone, Thursday saw the ECB keep interest rates unchanged at record lows and said that monetary stimulus, the expansion of the balance sheet, and the outlook for price developments will only be reassessed early next year. The Eurozone GDP growth was confirmed at 0.2% in the third quarter of 2014. What's contributing to these results, and what does it mean for the euro?
The thing is, when you look at the numbers, like you said, 0.2% is a very weak number, but funnily enough, within the markets, everyone was really happy at the GDP figures that came out for this quarter, because of the fact that Germany managed to avoid recession, which of course is a big deal. If they'd gone into recession, that would be absolutely massive for the Eurozone. And the Eurozone figure did tick slightly towards the upside, but really it shows the kind of problems that they've got over in the Eurozone, essentially, that is actually a positive thing for them, and a number anywhere near that kind of figure. And really, this is driven by a number of different things. In terms of what's happening over at the ECB, you said that they're going to keep interest rates and the like stable for the time being. We're going to look what's going to happen in the first quarter and reconsider then. But, I guess Mario Draghi for the time being wants to try and see what's going to happen in terms of the measures he's already implemented, in terms of that ABS program and also those TLTROs. The last time that we saw a take-up in the TLTROs, it was particularly weak. The banks only took up 82.6 billion euros, and people had expected around about 150. So on the 11th of this month, we're going to be watching out and seeing when the second tranche is taken up. And if we see another weak take-up, really it reflects the unwillingness of banks and firms within the Eurozone to actually invest at the moment, because there's not necessarily the demand within the Eurozone as a whole.
Finally, the US non-farm payrolls have just been released, 321,000 in November, ending the year on a high note. What is your initial reaction to these figures?
Well, of course, it took everyone by surprise, both in these offices and all around the world. I think, this is the strongest figure in around about 3 years in the non-farm payrolls. And what struck me was the fact that in the past, whenever we've had positive readings, they've always been accompanied by some sort of weak reading across some of these other measures that are actually released within the jobs report. So you might see a strong non-farm payrolls figure, but you might see a weakened unemployment rate, or you might see a weakened average earnings figure. On this occasion, none of the figures have gone down, and none of them have gone lower than expectations. So we've seen average hours and average hours worked. Average earnings and average hours worked, both increasing more than people expected. Again, a very strong non-farm payrolls figure. Unemployment rate remained the same, as did the participation rate. So overall, it's a very strong release.
Thanks, Joshua. As always, it's been great to speak with you. That brings our weekly wrap-up to an end. Thanks for watching and have a great weekend. Bye for now.